and now we'll take a look at an overall operating policy that the oil companies may be purchasing. The oil companies usually, and again, it's not every case, but this is the majority of the cases, the oil companies will have their own operating package policy, which will consist of a number of sections. There'll be the property section, operators extra expense, which is the control of well that Jeff was just talking about, liabilities, which will come up in the next presentation from Paul. They are the sort of most common three basic sections. In addition to that, some oil companies will buy business interruption or loss of hire. That may be an additional section. Construction risks, which we talked about yesterday, can be placed on a standalone basis, or sometimes there might be small constructions within a package. Oil in store, so that's the product actually being stored, and co-venturers interest. And we mentioned in this morning's presentation that there is often the requirement that the operator will provide terms and conditions for the co-venturers. Sometimes they will actually insure the co-venturer's interest within the package policy. From your point of view as underwriters, the property element, the package insurance is really the risk that you want to be writing. But obviously in a commercial world you can't just write the property package and not write anything else. But we talked about yesterday some of the risks and costs associated with construction insurance. Jeff touched on control of well not necessarily being the most popular risk, particularly if it's a single well operation, because from underwriters' point of view there's no halfway house there. It either goes well and makes money or they lose a fortune. So the property element is the cream risk, if you like, and from an underwriting perspective it's getting the balance between writing property as well as control of well and construction. And clearly from our point of view as the broker working on behalf of the client, if we have underwriters that are keen to write the less attractive parts of the risk, you're going to try and help them out and be able to offer them the more attractive. So it's part of the negotiation that goes on between broker and the underwriters. Probably fair to say that the property section is the most attractive from an underwriting point of view because it has the least amount of losses comparatively, but there are still losses and some of them very significant. Cliff touched on the lessons learnt from Piper Alpha. That was under an operating policy. There's been other big losses in Norway back in 1980. There was the Alexander Keeland, which was a unit that sunk and cost 123 lives. So there are big significant losses, but generally the property all risks policy is the preferred risk from an underwriting point of view. Another schematic similar to the ones that we've seen before, but that's just included because that's giving you an idea of the types of structures. Jeff touched on some of them, Cliff touched on some of them yesterday. And the only reason I've included it there is that what we're talking about with the operating policy, it's a broad form and it's an adaptable form, and it can cover any one of these. So all of these offshore structures, and basically as you go into deeper water you're becoming more technical units, but all of them we've mentioned at different times. All of them can be insured under a conventional operating package policy. So what is it that we're actually insuring? Well, it's all risks of physical loss or damage to the offshore property. You can include anything that you wish to declare under there. So any property that you have, if you include it in the description, it's included in the submission that we take to the underwriters, and there's a premium charged against it. If it's property, it can be included. And one of the key messages from Jeff's presentation this morning, control of well is not a property risk. So in the non-energy world, I think most of us are familiar with standard property, standard liability. The control of well is a unique product because it's not a property risk, it's insuring holes in the ground. This part of the presentation is probably the easiest one to understand, in that property is property. It's just that this is offshore, so therefore it's more expensive. There's costs of mobilisation and demobilisation of specialist equipment if there is a loss. But it's a property form, so it's like insuring a building, but it's a bit more technical. So the point of the definition there, it can be pipelines, it can be structures, it can be flow lines, it can be subsea equipment, anything that the insured owns can be included within the description. So we're covering physical loss or physical damage to the actual assets themselves. Some insured under the policy, the standard policy, and it's a new replacement cost. And there are various sublimits which we'll talk about further in the presentation: removal of debris, sewer and labour, and other extensions and endorsements that can be purchased. So what is it that you as an underwriter are offering coverage for? What are the main perils that you're insuring? Clearly, with hydrocarbons present, fire and explosion is the biggest risk. Fires in processing areas, gas leaks from defective pipelines, they're all covered. Offshore, we mentioned yesterday, Paul said in his presentation, what's the difference between onshore and offshore? The key thing is space and the lack of space offshore. So if you do get a gas leak, it's going to accumulate in a small area. That can have catastrophic consequences. Blowout and cratering. Jeff's presentation this morning was talking about the controller well. You will often have, in an offshore operation, it's a lifetime operation. So from the point of the initial construction through to the drilling of wells, the installation of an offshore structure, whether it's a jacket or whether it's a gravity-based structure, there is activity going on. There will be wells that will be drilled, there will be new production wells drilled, there will be injection wells drilled during the life of the lifespan, because the reserves deplete as they're being extracted. The oil companies wish to extract as much as they possibly can. So the reservoir, the pay zone that they're accessing, changes and moves over time. So there'll be injection wells being drilled to keep up the pressure, to enable the oil company to extract as much as possible. So that could be going on either from the actual asset itself or with a drilling unit coming in and working over or alongside. So there's always a risk of blowout. As far as the fixed asset is concerned, the controller well may be under the controller well policy, but you've got a large fixed asset there. You could get cratering of the seabed following a blowout, in which case the substructure is seriously damaged and you end up with very serious damage here, or even potential loss. It was a few years ago, we were doing some work for BP in Vietnam, and they had a controller well incident offshore. The cratering was, as a result of the blowout, the cratering was so huge, if it had happened right underneath the unit would have been swallowed up in one go. Fortunately, it was to the side, but if the crater had come up here, the crater that was created from the blowout would have just sucked the unit underground. Other risks, clearly storm damage. We talked in this morning's presentation about the risks for controller well, the parts of the world that you're operating in. Storm damage is clearly an issue if you're in the UK North Sea, Norwegian North Sea, northern Canada, the China seas. You've got cyclones and cyclone damage, Philippines, Australia. You could have ice damage. Then there are off the coast of Canada, you've got big risk of ice during the winter seasons, and so the structures are built with a band around them to protect against ice damage. Vessel impact. Very often the structure will be situated in an area that's close to shipping lanes. There are all sorts of safety rules and regulations about not encroaching within 500 metres or 1,000 metres, a safety zone around the structure. Many vessels ignore that, or if they believe that there's because of the structure, that can attract fish, so they will think it's good fishing ground. So some parts of the world, you'll get fishermen that try and come far too close because they'll think it's a good opportunity to catch fish. So there's vessel impact. There will be equipment going out to the vessels and providing supplies. They may strike the unit. Okay. Mentioned a moment ago, alterations and tie-ins. Once the asset is in place, it's very rare that it doesn't change. Some work will happen during the lifetime. It might be a tie-in to another project. In very developed parts of the world, like the North Sea, there's lots and lots of infrastructure. As smaller fields are discovered, the field may be insufficient to have a big structure like this put on it, but you might have some subsea wellheads that tie back to these units, and then there'll be a connection. During that connection, there'll be tie-in work happening. There'll be alterations to the project itself over time to keep up with the reserves that are there and to keep up with the reservoir depletion. We talked about the construction policy yesterday. Within the operating programme, you probably find that in terms of frequency, there's possibly more construction-related claims that fall under the operating policy during the discovery periods, but they're generally not huge. They're not as expensive and as dramatic as things like Piper Alpha. But you'll often find that if there's been accelerated corrosion on a pipeline, it manifests itself during the operating period and ends up with a claim being on the operating policy. Dropped objects, there's some very heavy equipment that's used in offshore installations. If that equipment gets dropped, that can cause some significant damage. So what is it that we need to take into account when assessing the risk and looking at how it should be rated? So first of all, the type of location, the type of object. Is it prototypical? If it's prototypical, that will cause concerns because no one really knows how it's going to operate and how it will perform. If it's tried and tested, there'll be a track record. Underwriters will know that it's good, bad or indifferent, but they will have some record in which to base the rating on. If it is prototypical, there'll be a nervousness until such time as they understand how it operates. Whereabouts it's going to operate, weather conditions, shipping activity, how close it is to repair yards and to be able to get equipment there in the event of significant loss or damage. So the infrastructure that might be around it, the water depth, the deeper it is, generally the riskier it is. Clearly the valuation. Underwriters have, the leading energy underwriters have a huge database of similar risks. They will have an idea of what the valuation is. The underwriters won't be telling the client what the valuation will be, but if we as a broker go in with something that's clearly out of kilter with other objects of a similar type, the underwriter 7 or 8 years, but it does blow every year. Earthquake areas of the world, ice damage in Canada that we mentioned. So there are clearly issues of acts of God that need to be taken into account in certain parts of the world. In other areas, the Middle East, for example, rating for Middle Eastern structures is very, very cheap, but it's a very benign region and very little activity in relation to acts of God. Capacity required is an issue. It's probably fair to say at the moment less of an issue because there is so much capacity in the market. If you go back to the 1970s, there were many, many, many structures and assets that were more than the total available insurance in the world. So therefore, the broker's role was key in trying to secure the most capacity at the most competitive price. Today, offshore capacity is probably, the maximum amount that's available is probably 6 to 7 billion. Jeff will touch on this in the market review. The realistic capacity $3 or $4 billion, and there's very few risks. Statoil, the Norwegian oil company, have some very large structures in the North Sea. A couple of theirs, and they buy BI, so a couple of their structures are capacity risks, but there's very few. But if you need a lot of capacity, the client's going to have to pay the premium. And it's a supply and demand market. If underwriters see a value that they know needs a lot of premium, they're going to be looking for a very good rate for it. The operator and their records, their performance, clearly if they've had a good loss record, that's going to be treated favourably by underwriters. Less good record, not so favourably. And by the operator as well, it's their approach to buying insurance. There are some companies, some parts of the world, where it's a requirement that business goes to tender every year or every 3 years. Underwriters will write that business, but there's no long-term relationship with that. We're very fortunate with the length of time that we've had the Petronas relationship, and the leaders on that have been with that programme for a very long time. So they've had good years and not so good years, but overall they see it as a long-term relationship. So one of the benefits is that it takes out the peaks and troughs. I think from an oil company point of view or a contractor, insurance is one of your biggest fixed costs. And when it comes to budgeting, what you want to be able to do is to try and squeeze those fixed costs so that it's easier to budget. You don't want to be having huge rates going up and down, up and down. You really want a nice smooth line, and if you've got a long-term relationship, you've got a much better chance of being able to maintain a steady rating. Maybe you don't get the big reductions in a soft market, but you don't pay the big increases in a hard market. And I think time has proven that if there is a good relationship, long-term relationship between the client and the underwriters, if you've got contentious losses, the underwriters do tend to be more sympathetic to a long-standing client. And you would expect that. That's just, that's the market that we live in. If they didn't, why would the client be loyal in the first place? So insurance is nothing but a promise to pay. So you want to build up that relationship. Again, in yesterday's construction presentation, we talked about the transfer over. If it's a straight transfer, handover from the construction stage to the operational stage, a very simplified, straightforward handover, that's very easy. Usually there's outstanding elements, there's punch lists outstanding, but at the same time the oil company will want to start getting some of their money back. The only way they can do that is to get into production. So therefore, you will see construction work going on at the same time that the operational phase has started. So that's something that needs to be taken into account from an underwriting point of view. And possibly the most important point is the market dynamics. What's the market doing at the time? We're in a very soft market at the moment for a number of reasons. There's so much capacity. We'll go into more detail in the market presentation. But at the moment, regrettably from your point of view, the market is very soft. There hasn't been any big losses for some time, and there's been a huge amount of capacity that hasn't gone into any other line of business. But perhaps we're beginning to see some changes, but we'll hear more about that this afternoon. So if we're looking at an operating policy, what sort of form are we looking at? And there are many forms, and there isn't the time now to go through all those forms. And essentially the forms all do the same thing. It's a property form, and the one that we sort of touch on here is the London Standard Platform form. Clearly it's a very good form because it was first introduced in 1972 and it's still around today. So the industry has changed enormously, and that form has been able to change with it. It was initially constructed as a standalone insurance policy, but is now used within package policies. What that does mean is the broker needs to be careful when they're drafting the slips, because the platform form includes a set of general conditions. So if you're drafting a slip and you include general conditions within the slip, you need to make sure that they don't conflict with the general conditions that are in the platform form. So there is a need to make sure that the slip has been drafted correctly and that there's no ambiguity in the slip drafting. From the client's point of view, one of the attractions of the form, it's an all risks form, and you don't need me to say or to tell you that an all risks form is much better from a client's point of view. It means the onus is on the underwriters to prove an exclusion to avoid a claim, rather than under a named perils policy where it's up to the client to demonstrate that the loss was caused by one of the named perils. As a result of it being an all risk form, there's probably more exclusions in that form than in many of the other energy forms, but that's because the form has been around so long, and as it's been developed and arguments put forward, it results in more exclusions coming in. What does the form apply to? Well, we showed in the earlier slide the fixed and floating platforms. It is a very adaptable form. It can be used to cover pipelines and subsea property. There are other more specific forms out there, but the London Standard platform form will cover pipelines and it will cover subsea property. From a broking point of view, there's a certain comfort with using it for both the brokers and the underwriters that it's such a common form. Those that are involved in the industry on a day-to-day basis know what it covers. There are a lot of exclusions that we'll go into, but most of us know most of those off the top of our head. It's a form that has been tried and tested. We said earlier, it's been around since '72, and it's therefore a very flexible form, and it meets the industry's needs and the changes that the industry has seen in the last 50 years. So the structure of the form, and as always, from a broking point of view, you start off with the slip is the negotiation between the broker and the underwriters. You wouldn't see the full form listed in the slip. It would be referred to by name only. When it then comes to putting the wording together, you'd be using the platform form as the basis of your wording, and you would adapt that form to take into account specific terms and conditions that are in the slip. The form itself starts off with declarations and a schedule, and basically that schedule is where you list the equipment that you're covering. If it's not in the schedule, it's not covered, so it's very important for the buyer to make sure the broker knows what equipment is being covered, and we show in a minute the type of information that's needed. The schedule is followed by the insuring agreements, what is covered and the basis of cover, which includes some definitions. And again, some of those definitions are definitions that the market have come up with themselves over time, or as a result of if there has been litigation and there's been clarity from courts, some of those court judgments are then brought into account through the definitions. Includes the principal conditions and exclusions. We mentioned earlier there's quite a few of those, but that's because it is an all risks form. And then there are some additional buyback endorsements and extensions that you can buy to bolt on to the standard form. So what does the declaration look like? Very simple. That there is a very simple document. It can be as large and complex as the client needs, depending on how much equipment they've got. We're showing there the description of the property, where it is, the insured value on a 100% basis, and then we mentioned yesterday that it's very rare that one oil company will own 100% of an asset. It can happen, but there's usually partners, so you'd put the assured's particular interest in there, and then so the premium is calculated as is a rate based on the value, and then takes into account the client's working interest. You can add additional columns if you wanted to break out the descriptions between platforms and subsea and pipelines, but generally, as long as it's scheduled within the declarations, the coverage will be there. If you've got a huge oil company, Petronas for example, if you were to describe every piece of property, this would run into hundreds of pages. So for the bigger oil companies, you're using a more generic form. If you've got a small oil company, you'll have very detailed information. So it's very much what the risk is and how you're going to be able to broker that to the market to, one, make sure the market understands the risk, but also at the same time to obtain the best terms you can for the client.
Excuse me. We have
Mhm.
It's almost certain that they would go for contingent joint ventures cover.
Would they include the joint venturers? That interest there would be the assured's interest. If you include the joint venturers, that would be done as a separate.
Contingent, just in case if the co-venturer
Yeah.
does not take a particular kind of cover, this insured should not get into any kind of trouble.
No, that would be the insured's working interest.
He's asking whether or not you have a contingent joint venture.
Contingent, yeah, contingent.
The question actually relates to contingent.
Oh,
Contingent, which is like we do in the OE.
yeah. No, you would. The joint venture interest is a separate section, and
They don't do it.
no, there isn't a contingent. So, no, there is no provision within the London Standard Form.
That's kind of a unique thing for the control of wealth, as far as that element of it is concerned. You can have joint venture clauses, but the contingency is really more to do with the control of wealth.
Only for that.
Yeah.
Because my question was, insured should not suffer because of any lapse of the co-venturer.
They won't, because they're not insuring the co-venture. If the co-venture, say, got 10% and he fails to insure it, or his insurers go bankrupt, that's his problem, not the operator's problem. Because he'll be responsible under the joint venture agreement for his proportion of costs.
I agree. But why in blowout?
Yeah, and control of wealth.
Well, that's a different issue.
Excuse me. You're saying this cover is on a grid value basis.
Yes.
And yet, say for example, if the operator interest is 60%, how do you then work out their grid value basis? Is it 60% of the total sum insured?
If the insured value was $10 million and the insured's interest was 60%, it would be $6 million. And the agreed value, what is interesting is that underwriters may see the same risk, the same asset from different clients because of the working interest. And they don't all have to insure it on the same basis. So you could an underwriter could see an asset from 4 different clients with 4 different valuations, because some may have got financing involved and the banks have got certain obligations, and so therefore they may have a higher value than someone who has got a smaller interest in it and it's not a key component for them, and they may have a lower book value. And the market it can cause confusions. For instance, if you had a loss, what could be a constructive total loss on one policy isn't a constructive total loss on the other. But the market approach is, the market is there, the insurance is there to support the industry. So there is an understanding and an acceptance that an asset has different values to different people. So you don't get one asset being insured on its own. Many years ago, when the industry first started, that's how many of the assets were insured, and it would be done on an asset basis rather than each oil company having its own package. And by having its own package, they may have bought the asset from another oil company, and it might have been a distressed sale and they got that at a much cheaper price, and to them the value is not as great as one of their partners. And so the underwriters accept that and realise that there are different values, which can cause problems in the event of a large PA loss. On one policy that might end up being a constructive total loss, but on another policy it may not. The additional limits, I'm sure by now you're probably getting bored of seeing this 25%. The industry likes 25%. So the cost of averting or minimising, which is effectively Sue and labour, but Sue and labour is very much a marine term, and whilst the offshore, the London Standard Platform Form is used for primarily offshore properties, it can be used for onshore properties if it's part of an overall package. And so the averting or minimising is effectively Sue and labour, but that applies to both onshore and offshore. But as with Sue and labour, it's 25% of the sum insured on any one accident or occurrence basis, unless it's scheduled separately. And again, the policy is flexible. If a client wanted a higher limit and had a reason to, they would tell the broker, and that would be a negotiation with the underwriter. The underwriter may either agree it and say, yep, that's fine, I accept that, or he may agree it and charge an additional premium. We saw in Cliff's lessons learnt this morning, there are some very big structures, and when there is a big fire, big explosion, it can cause considerable wreckage. And so there is often an obligation for wreck removal, debris removal, and there have been occasions where 25% of the insured value may not be sufficient for wreck removal. And there are all sorts of issues. The oil companies don't want to spend money unnecessarily. If they can leave the wreck on the seabed and it's not interfering with anything, that's what they'll try and do. Depending on which part of the world it is and which regulations are in force, there may be a requirement because, for instance, in the North Sea, there is it's a contractual situation that the government, the British government, don't want to be left with the responsibility to clear up the seabed and remove it. So the operators retain the obligation to leave the seabed as they found it. That regulation doesn't apply everywhere. Oil companies will often present an argument that says, well, it's better for the environment to leave it where it is. If we try to remove it, there could be pollution issues, there could be increased risk. They're not really that bothered about the pollution issues, they're more bothered about not having to spend money. So if they can leave it there, they will leave it there. The two combined, there is usually a limitation that says the additional coverages are limited to 50% of the insured value, so 150% in total. So the insuring agreements, the loss or damage, what is it that we're covering? Indemnify the insured for direct physical loss or direct physical damage to the property insured resulting from any cause which is not excluded. These words have changed significantly over the years because it started out originally as being from loss or damage, and loss or damage doesn't mean necessarily physical, and so brokers in the past working on behalf of their client would make a representation to underwriters that there's been loss or damage. Underwriters' view would be the idea of the policy is to pay for physical loss or damage. The broker would argue and say, well, it doesn't say physical loss or damage, it says loss or damage, and there has been damage. Maybe not physical loss, maybe not physical damage, or maybe there's been loss but not physical loss. So the words physical were introduced. Originally, physical came into physical loss or damage, and then there was an argument that you could have damage that wasn't physical, so the word physical was inserted before loss and damage. Initially, the word direct wasn't there. So what tends to happen, and we mentioned yesterday, there's not too much litigation, but there are lots of claims negotiations over the years, and as a result, underwriters may feel they've paid more than they should have done. So what will happen is that there will then be a revision to the words, and there is a group in London that represent the energy market, which is the Joint RIG Committee, and part of their role is to try and standardise forms wherever possible. So the RIG Committee will meet from time to time, and they may be looking at construction or they may be looking at control of well. When they look at operating, they'll look at the losses, and that they will make recommendations to the form, and there will be a revision to the form. So over time, and when we look at the exclusions in a minute, you'll see that additional exclusions have been added as brokers have demonstrated or tried to negotiate a claim that the underwriters felt shouldn't have been covered. Within the insuring agreements, deliberate damage caused by a government authority. Why would a government authority deliberately cause damage? It's usually in relation to pollution. So if there is risk of an oil slick affecting the coastline, the government may instruct that something be destroyed beforehand or something set fire to stop the oil from reaching land. So the government can interfere and has the right to basically destroy property in certain territories. The UK sector is one of those. If they came along and issued that edict, then the policy would respond. As long as there wasn't a want of due diligence by the insured, so it wasn't a deliberate act. They haven't let something happen that good operating practice wouldn't have let happen. We cover faulty part. Again, we've talked about faulty part in the construction form. It's a contentious area. It's been an expensive area from underwriters' point of view. So results of the resultant defective part, design or materials, workmanship or latent defect is covered by the form, but it might have even been, particularly with latent defect, it may have occurred prior to attachment, but the form will pick it up. In addition to the standard clauses, what else will it cover? On the marine side, again, most of these structures are offshore. General average, so general average being a cost shared amongst everyone in an adventure. So if there's a deliberate sacrifice to save property, if somebody's property has been sacrificed to save the overall, rather than that one person suffering, the cost of that deliberate sacrifice is shared amongst everyone who has an interest in the adventure. Salvage and salvage charges are covered. Stern and labouring clause, measures as may be reasonable for averting or minimising physical loss or damage to the property insured, is included. And there's the language there for attempting to remove wreck and removal of property. One of the things that came out following Piper Alpha, there were 167 people that lost their lives, and there were questions raised as to whether there was an obligation for those bodies to be brought ashore or whether there wasn't, and whether the policy would respond. And one of the things that's been clarified since Piper Alpha is that the policy will respond for the retrieval and removal of bodies. So as far as removal of wreck's concerned, the wreck removal has to result from a peril insured against. So just because it's got to the end of its life and you can't make a claim on the policy unless there's been loss or damage that is recoverable under the policy, or is compulsory by law or ordinance. As we said earlier on, the government may require it to be removed, or sometimes the government may say you can't remove that, it's got to stay there. If, for example, it's over a pipeline and to remove it would damage the pipeline, they may say, well, no, leave it where it is. If it's close to a shipping lane, they're likely to say, no, you've got to remove it, particularly if it was in shallower water. So the policy will respond in relation to legal requirements, ordinance issued by the regulatory authority. How will the policy respond? Again, it's a flexible form, and the market acknowledge and understand that things change over time, and when a loss has happened, it may be that they don't wish to repair things in exactly the same way. So for repairs or replacement of a similar nature, it's basically making good. It's to put the assured back in the position they were